Millions of UK workers are about to face a financial shake-up they never saw coming. From April 2025, the government is rewriting how income, savings, and even overseas assets are taxed. And it's not just the wealthy who'll feel it. Rules that once protected ordinary earners are being replaced, quietly changing what you'll owe on your next payslip, investment return, or property sale. If you earn abroad, rent out a flat, or even run a small side hustle, these new laws could reshape your take-home pay. Here's what's really changing, and why it matters more than you think. Number 10. The shift to a residence-based global tax identity. The most defining feature of the 2025 UK tax reform is the shift toward a residence-based global tax identity, marking the end of centuries of domicile-driven rules. This new framework means that where you live and how long you have lived, there will determine your entire tax responsibility. Under the updated law, anyone who spends substantial time in the UK, typically more than 183 days a year, will be taxed on worldwide income, gains, and assets after their 4-year FIG period ends. This approach aligns the UK with global norms and simplifies administration, but it also brings a profound change in how workers perceive their financial connection to the country. Living in Britain will now mean full fiscal participation, regardless of where wealth is generated. For millions of ordinary residents, this evolution closes loopholes that once separated global wealth from domestic tax. It ensures that everyone using public infrastructure contributes proportionally to its funding. However, for those who have built international careers or own property abroad, the new rule demands greater financial vigilance. Annual declarations must now include foreign income, overseas bank interest, and even profits from digital assets held outside the UK. Failing to disclose accurately could trigger penalties or interest under HMRC's strengthened enforcement powers. The change also integrates with global tax transparency networks, enabling automatic data exchange between the UK and dozens of other jurisdictions, effectively removing the anonymity once associated with offshore income. This transformation is more than a legislative adjustment. It reshapes the relationship between residency, responsibility, and reward. Individuals planning to relocate to or from Britain must now consider tax exposure as a central part of their decision-making. The government's message is clear. Fiscal boundaries no longer stop at the coastline. Workers who once viewed foreign earnings as separate from UK taxation will need to adapt to a world where residence equals global accountability. For most, this reform brings clarity and fairness. For others, it demands a complete rethinking of financial structure. The 2025 shift establishes a new standard of transparency, aligning the UK's tax system with modern mobility and ensuring that every resident, permanent or temporary, plays a visible role in sustaining the nation's economic foundation. Number 9. Higher capital gains tax on carried interest for investment professionals. The 2025 tax reforms introduce a critical update for fund managers and private equity professionals. The capital gains tax (CGT) rate on carried interest will rise from 28% to 32%. Carried interest represents the share of profits that investment managers receive from successful funds, and for years it has been a point of political debate. The government argues that the new rate brings greater fairness by aligning how labour and investment rewards are taxed. This adjustment aims to ensure that those earning large profits through fund performance contribute proportionally more to the UK economy. For senior partners and hedge fund executives, this increase could translate into substantial additional liabilities, depending on the scale of their portfolio returns. Beyond the headline rate rise, the reform also introduces tighter conditions for determining when carried interest qualifies for capital gains treatment instead of income tax. HMRC will scrutinise the duration of investments and the nature of returns more closely, ensuring that gains genuinely stem from long-term risk-taking rather than short-term performance fees. This means investment structures may need to evolve, with firms re-evaluating their holding periods, profit distribution methods, and investor agreements. The change could influence how funds are structured in London compared to rival markets like New York or Singapore, where tax treatment often remains more favourable. Nonetheless, policymakers believe the UK's stability, investor confidence, and financial infrastructure will offset any competitive disadvantage. For employees and investors within the finance sector, preparation is key. Many firms are already reviewing their partnership structures, bonus frameworks, and cross-border arrangements before April 2025 arrives. The new 32% rate may also push fund managers to time disposals carefully, realizing gains before the new threshold applies. Those planning to relocate for tax reasons should weigh the potential loss of UK residency benefits against the costs of moving operations overseas. While this change targets a specific segment of high earners, its ripple effects reach further, affecting investors, pension funds, and the broader financial ecosystem. The government's clear intention is to strengthen the integrity of the tax system, ensuring that success in the financial markets contributes its fair share to public revenue, while maintaining the UK's reputation as a globally responsible financial hub. Number 8. The rise of the side hustle economy and new tax thresholds. As the number of freelancers, content creators, and part-time entrepreneurs continues to grow, the UK government is updating its approach to side hustle taxation in 2025. The trading allowance, which determines when small amounts of extra income must be declared, is set to rise from £1,000 to £3,000 per year. This change recognises that more people now earn supplementary income through platforms like Etsy, eBay, and digital freelance services. For millions of workers juggling full-time jobs with small online ventures, this increase offers welcome breathing room. It means that if your side earnings stay below £3,000 annually, you may not need to file them separately with HMRC, simplifying compliance for casual earners and part-time sellers. However, the higher allowance comes alongside a stronger push for transparency. HMRC is expanding its data-sharing partnerships with online platforms, meaning that marketplaces and payment apps will automatically report users' income data. The intent is to capture those operating beyond hobby-level trading who previously slipped through the cracks. Anyone earning more than the new £3,000 threshold will still need to declare their income and possibly register as self-employed. The system is designed to be fairer, protecting small earners from excessive red tape while ensuring that larger digital operations pay their fair share. This move also aligns with international trends as countries worldwide adapt tax systems to accommodate the digital economy's rapid growth. For workers, the change is both an opportunity and a responsibility. Those using side income to offset living costs or explore new ventures can now operate with greater freedom, but keeping detailed records remains essential. Earnings through PayPal, Stripe, or direct transfers will all count toward the total threshold. The key to success lies in understanding when your hobby becomes a business and preparing for the shift before HMRC does. Financial experts recommend using simple accounting apps to track invoices and expenses throughout the year, avoiding the stress of sudden tax surprises. The higher trading allowance symbolizes the government's acknowledgement of the modern gig economy, but it also draws a clear line. Side hustles are welcome, yet they must remain transparent, traceable, and responsibly managed within the UK's evolving tax landscape. Number 7. National insurance adjustments and payroll reform. From April 2025, the UK's National Insurance (NI) framework will undergo one of its most significant overhauls in years, reshaping how both employees and employers contribute to the system. The primary rate for employers' national insurance contributions is set to rise by 1 percentage point, while the employee threshold for contributions will shift slightly upward to ease pressure on lower earners. This means businesses will face higher payroll costs, while some workers at the lower end of the income scale may see marginal relief. The change reflects the government's attempt to balance public finances following years of economic strain while keeping employment incentives stable. However, it will still create ripple effects across industries, especially for small businesses and contractors operating on tight margins. Another major element of the 2025 update is the simplification of real-time payroll reporting. Employers will no longer be required to submit detailed hours worked data for every employee, reducing administrative load and data privacy concerns. Instead, the focus will be on accurate pay, deductions, and contribution details filed through RTI submissions. HMRC aims to modernize payroll systems to make compliance smoother and errors easier to detect. For many employers, this could mean upgrading payroll software, retraining staff, or working closely with accountants to adapt before the changes take effect. The reform also introduces clearer guidance for hybrid and remote workers, ensuring national insurance is applied correctly when employment contracts cross regional or national boundaries within the UK. For employees, these reforms carry mixed outcomes. While lower earners could benefit from threshold adjustments, middle-income professionals might notice slightly higher deductions. Self-employed. Yet individuals will need to watch closely for updates to Class 2 and Class 4 contributions, as further alignment with the employee system is expected in 2025. The government's stated goal is a fairer, simpler structure that ensures consistent funding for health and social care without punishing productivity. Yet, for businesses managing large teams or international contractors, the administrative shift could require careful planning. The message is clear. The national insurance system is evolving to reflect modern work patterns, and both employers and employees must understand how these new thresholds and reporting rules will influence their pay packets, budgets, and long-term financial planning from the first pay run after April 2025. Number 6. Stricter HMRC enforcement and rising interest on late payments. From April 2025, the HMRC will significantly tighten its approach to tax enforcement, aiming to reduce underpayment and improve compliance across all income brackets. The most notable update is the rise in interest rates on overdue taxes, which will now sit at 1.5% above the Bank of England's base rate. As inflation and interest rates fluctuate, this could mean far steeper penalties for anyone who delays payment. HMRC is also expanding its use of data analytics and global information sharing networks, allowing it to cross-check income declarations against records from banks, employers, and foreign tax authorities. For ordinary workers, this means fewer errors will go unnoticed, and even small discrepancies in tax returns could trigger closer examination or fines. The government's position is that stronger enforcement will ensure fairness across the system, preventing compliant taxpayers from carrying the burden of those who evade. However, this shift also places new pressure on individuals who manage multiple income sources, freelance contracts, or small side businesses. Late payments and inaccurate reporting can now accumulate interest at a faster rate, eroding savings or profits. For instance, a self-employed professional who misses a quarterly payment might find that penalties mount faster than before, turning a small oversight into a costly mistake. The updated system also enhances HMRC's power to collect overdue sums directly through salary deductions or asset recovery when repeated non-compliance occurs. To avoid unexpected penalties, workers are being urged to strengthen their record-keeping, use digital accounting tools, and pay close attention to filing deadlines. For those earning from freelance or international work, consulting a qualified accountant before the end of each tax year can help anticipate liabilities early. The reform is part of HMRC's broader modernization drive, reflecting its belief that technology and transparency are the keys to sustainable revenue growth. While some critics view the changes as overly aggressive, they align with the government's ambition to close the tax gap and reinforce fiscal discipline. The new enforcement climate signals a clear expectation. Every taxpayer must stay proactive, precise, and timely. The margin for error is shrinking, and financial awareness has become as essential as earning itself in the UK's evolving tax era. Number 5. Capital gains tax rebasing and its strategic advantage. Another key reform arriving in April 2025 involves capital gains tax, CGT, rebasing for individuals who previously benefited from the non-domicile system. This provision allows qualifying taxpayers to reset the base value of certain foreign assets to their market worth as of 5 April 2019. In simple terms, if an asset, such as overseas property, shares, or business interests, has appreciated in value before that date, the gain accumulated up to 2019 can effectively be ignored for future tax calculations. When the asset is eventually sold, capital gains will be calculated from the 2019 value rather than its original purchase price, potentially reducing the taxable profit considerably. The goal behind this reform is to smooth the transition from the old domicile rules to the new FIG regime, preventing what would otherwise be a sudden surge in tax bills. However, this benefit only applies to individuals who transition into full UK taxation after the FIG grace period expires. Those who have been UK residents for many years without interruption may not qualify. The government intends the rebasing option to act as a one-off concession for returning expatriates and foreign nationals adapting to the new residence-based framework. To take advantage of it, individuals will likely need to provide clear evidence of asset values, professional valuations, and accurate ownership histories. Without proper documentation, HMRC could challenge any claimed revaluation, leading to disputes or penalties. The strategic element lies in timing and transparency. Tax experts recommend reviewing foreign holdings before April 2025, identifying which assets might qualify, and gathering valuation records early. Selling rebased assets after the new rules take effect could produce a far smaller taxable gain than disposing of them beforehand. For investors with long-standing international portfolios, this relief offers a temporary but valuable cushion. It softens the blow of losing non-dom privileges while rewarding those who comply promptly with the reformed system. Yet, it is not an automatic advantage. It demands preparation and precise reporting. The rebase is a final opportunity to align international investments with the UK's stricter tax landscape, a rare moment where good record-keeping can translate directly into meaningful financial savings. Number 4. The new inheritance tax rules based on residence. From April 2025, the United Kingdom will move from a domicile-based inheritance tax (IHT) system to one determined by residence. This shift means that long-term UK residents could find their worldwide assets, homes, savings, shares or businesses subject to British inheritance tax, even if those assets are held overseas. Under the old regime, a person's domicile of origin often dictated their exposure, allowing many to remain exempt on foreign wealth if they were considered non-domiciled. The new approach eliminates this distinction, introducing a rule that once you have lived in the UK for 10 out of the past 20 years, your global estate becomes taxable under UK law. For families who have lived in Britain for years while maintaining ties abroad, this is a major development. A person with a family home in Spain or investments in Asia will no longer be able to shield those from the UK tax net once they meet the residence threshold. Furthermore, the reform includes a tail period, meaning that individuals who leave the UK could still face inheritance tax liability for several years after departure. This prevents people from avoiding tax simply by moving abroad shortly before death or transferring assets overseas. The tax rate itself, 40% on estates exceeding the threshold, remains unchanged, but the scope of what counts as taxable property is set to expand dramatically. This change pushes many middle-income families into territory once reserved for the ultra-wealthy. Expats returning to the UK to retire, workers with family assets abroad, and entrepreneurs with international business interests will need to review their estate planning carefully. The key strategy now lies in timing. Understanding how long you have been a UK resident and how soon your foreign assets could fall under British IHT. Finos. INSIAL advisors are already urging clients to consider asset transfers, gifts or trust arrangements before the new system takes effect. For many, this reform represents not just a tax adjustment, but a profound redefinition of fiscal identity. It underscores the government's broader message. If your life and wealth are tied to Britain, your responsibilities to its tax system follow, no matter where your assets physically reside. Number 3. The removal of furnished holiday lettings and its hidden impact. From April 2025, the UK government will abolish the furnished holiday lettings (FHL) regime, a system that once offered generous tax breaks to property owners renting out short-term holiday homes. For years, this scheme allowed landlords to deduct more expenses, claim capital allowances, and even benefit from reduced capital gains tax when selling their properties. It encouraged the growth of coastal cottages, countryside retreats, and Airbnb-style rentals that supported local tourism economies. Now, with the FHL rules being scrapped, all rental properties, whether long-term or short-term, will fall under a single, uniform property income regime. This move is part of a broader effort to simplify the tax system, but for thousands of small landlords, it could mean higher bills and lower profits. Under the current system, property owners could offset mortgage interest, maintenance costs, and furniture replacements against their taxable profits more efficiently. With the new change, many of those reliefs will either be reduced or lost entirely. The difference might seem minor on paper, but it translates into significant financial pressure for owners who depend on rental income for their livelihoods. Holiday property owners will also lose the ability to treat their activity as a business for tax purposes, meaning they can no longer claim certain allowances that ordinary property investors cannot. This will particularly affect people who operate seasonal rentals in popular tourist areas, many of whom already face rising energy costs, tighter regulations, and fluctuating demand. The end of the FHL regime could also reshape the housing market itself. Without the tax advantages, some landlords may decide to sell their holiday homes, potentially freeing up properties for local buyers but reducing rental availability in tourist regions. Others may shift from short-term to long-term letting, changing how rural and seaside communities function economically. For workers who invested in small rental ventures as a form of side income, this marks a crucial turning point. The government argues that treating all landlords equally ensures fairness, yet critics fear it will discourage private investment in hospitality. As the 2025 deadline approaches, property owners must reassess their strategies, review costs, and prepare for a system where every rental, holiday or not, is taxed under the same demanding rules. Number 2. Global income becomes fully taxable after 4 years. Once the 4-year grace period under the new Foreign Income and Gains (FIG) regime ends, every form of global income becomes fully taxable in the United Kingdom. That means wages, rental income, dividends, and even capital gains from overseas investments will fall under HMRC's scrutiny. For many professionals who split their lives between multiple countries, this change eliminates the separation that once existed between UK and foreign earnings. After April 2025, the government will expect annual tax declarations covering not just domestic income, but also every offshore source, regardless of whether the money ever enters the UK. This represents a major shift toward transparency and a closer alignment with how most Western tax systems operate. The challenge is that this change does not only impact high earners or international investors. A growing number of ordinary workers now hold global assets, such as remote work income, online business profits, or overseas family property, that could be drawn into the new tax framework. HMRC has already begun expanding its data sharing agreements with other countries, allowing it to access information from foreign banks and tax authorities. That means unreported offshore accounts or rental properties are now far easier to trace. Workers who once viewed overseas income as outside HMRC's reach may discover that those assumptions no longer hold. The 4-year FIG window provides some breathing room for new arrivals, but after that, even modest foreign earnings will need to be declared in full. This adjustment will require smarter financial planning and professional guidance. People with dual income streams should start organizing their records, tracking exchange rates, and preparing for potential double taxation, though tax treaties between countries can sometimes offset poor Art of the burden. Many advisors suggest reviewing investment structures before the grace period expires, especially for those expecting long-term residency in the UK. The message from the government is clear. If you benefit from living and working in Britain, your global income should contribute to the public purse. For millions of workers who never considered themselves part of the non-dom conversation, this reform brings a powerful wake-up call about how international income will now be treated, and how crucial it is to plan before the 4-year clock runs out. Number 1. The end of non-dom status and the rise of the new FIG regime. From April 2025, the United Kingdom is closing the chapter on the long-standing non-domicile system that allowed many residents to avoid paying tax on foreign income. For decades, individuals who lived in the UK but claimed their permanent home was elsewhere could keep overseas earnings beyond HMRC's reach. This rule mainly benefited global professionals, investors, and entrepreneurs who maintained income streams abroad. The government now plans to replace this with a more transparent and residency-based model known as the Foreign Income and Gains (FIG) regime, designed to simplify taxation and create what officials describe as a fairer playing field for everyone living and working in the country. Under the new FIG structure, the focus shifts entirely from where you consider your true home to how long you have been living in the UK. Those arriving after being non-resident for at least 10 years will get a temporary break from paying tax on their foreign income and gains during their first 4 years of UK residence. After that period ends, all worldwide income, profits, and investment returns become fully taxable by HMRC. This transition period is meant to attract new talent and investors, but for many long-term residents, it marks a significant tax expansion. The scrapping of the remittance basis means that foreign income, even if not brought into the UK, could now fall under UK tax rules, altering how individuals manage their overseas accounts and property portfolios. The government expects this reform to generate billions in additional tax revenue, but it also forces many ordinary workers and returning citizens to reassess their financial positions. Someone with savings, pensions, or a rental property overseas will now need to report that income annually. The complexity lies in understanding what counts as foreign income and how transitional relief might apply for those previously using the old system. While some welcome the end of loopholes exploited by ultra-high earners, others fear the reform will discourage skilled professionals from relocating to Britain. Whether you are an expatriate moving home or a UK resident with ties abroad, the 2025 shift signals a new era of accountability, where every pound earned worldwide may finally fall within the UK's tax net. The 2025 UK tax overhaul represents one of the most comprehensive shifts in modern financial policy, touching every corner of the workforce, from international executives to everyday earners. By moving from a domicile-based model to a residence-based system, the government is redefining what it means to be financially tied to Britain. Workers who once viewed taxes as straightforward will now need to think globally, tracking income, savings, and investments across borders. Whether it's the abolition of the non-dom status, the introduction of the FIG regime, or the tightening of inheritance and property rules, these changes mark a new era of fiscal transparency and accountability. For millions, the reforms offer both challenge and opportunity. They encourage responsible planning, digital record-keeping, and awareness of one's financial footprint. Yet they also demand proactive action, understanding new thresholds, seeking professional guidance, and staying ahead of reporting deadlines. The tax landscape is evolving, and preparation will determine who benefits and who struggles under the weight of compliance. The message is unmistakable. Knowledge is now the strongest financial asset any worker can hold. If you found this breakdown helpful, hit the like button, subscribe for more updates on UK financial changes, and share this video so others can stay informed before the new rules take effect. Drop a comment below if you have a question about how these reforms might impact you or your business. For deeper insights and practical guidance, make sure to watch our next video on essential tax planning tips for 2025 and beyond.